Hello friends, welcome to my channel Basics of Tax Accounting. It's a place where we go over some of the key basics of tax accounting with a focus on US GAAP. Before we start today's presentation, please remember to subscribe to my channel. That will give you the full access to all the content that I have posted on my channel. So our topic of the day is Interim Reporting and ASC 740. So we'll discuss how ASC 740 provides regulation on how to report your taxes when you are doing your interim reporting for the quarterly posting of 10Qs. So we'll go over some of the key requirements of ASC 740 for interim reporting. So the first requirement is to calculate AETR, which means annual effective tax rate. What that means is when we are issuing an interim reporting financials, we do not know the actuals for the year, and we try to blend in the some of the actual figures with the forecast for the remainder of the year. And based on that information, we calculate an annual effective tax rate. So the idea behind doing this exercise is to allocate your tax expense in the several quarters during the year. How that is done is we apply the AETR calculated to the year-to-date results. We'll also go over some of the items that are not to be considered when you are calculating your annual effective tax rate. We'll go over how AETR and the tax rates are reported on your 10Qs, what's the relationship between the two, and then we'll also go over some of the key elements of entities that have multiple jurisdictions, how they tackle the AETR calculation. So moving on to discuss what is AETR. So generally ASC 740-270 requires the company to calculate the income tax associated with its ordinary income using an estimate of effective tax rate. So at the end of each interim period, the company applies that AETR to the ordinary income or loss to arrive at the YTD income tax rate. So the key elements for AETR are the effective rate, the best estimate, which is the forecast of the remainder of the year, and another key element is the valuation allowance. So the AETR should include any changes to the valuation allowance that arise from your deferred tax items. Right, so moving on, so allocation of tax expense and AETR. So as we briefly discussed, that the full data is not available to the company when they are trying to issue their interim reports. So we do not have the full year worth of data. So we use the forecast data. We reach out to the FP&A team or the accounting team to give us the forecast data. And then based on the forecast data, we calculate what the tax expense in each of the jurisdictions would be, and then we aggregate that to come up with an estimate effective tax rate for the year, which is also known as AETR. And then we record the tax expense for the interim period, which is your AETR times the year-to-date actual income. So we'll quickly go over some of the exclusions from the AETR, which are also known as the discrete items. So some of the key discrete items that are excluded from AETR are provision to true-ups, provision to return true-ups, changes to any of the recognition of UTP uncertain tax positions, any effect of stock-based compensation or taxes on any significant or extraordinary items which get reported in the period they are recognized, and any changes to the tax laws which are reported in the period in which the enactment of that tax law is effective. And also we exclude any changes in the assessment of VA, like VA recording. So if you had previously assessed that an entity needs a VA on their DTAs, and then in the subsequent period you think that the VA is no longer required, we do not make that change when we are doing interim reporting. We do that change when we are reporting our YTD actuals, which is at the end of the year. So moving on to the AETR and the reported income tax rate. So as you can see in this figure, AETR and YTD tax expense, they are like the opposite pillars. So you calculate the AETR and your YTD tax expense is based on the AETR that you have calculated with the when you multiply your AETR with the YTD pre-tax income actuals. That will give you the YTD tax expense. So what that does is it sometimes can exaggerate your tax items, because you are calculating your AETR and then applying it to your YTD actuals. It may cause some distortions in your YTD tax expense, because the way the AETR is calculated, it will include some of the forecast assumptions which may or may not have already happened. So when you apply your AETR to the YTD actual income, the results or the tax expense or calculated may be slightly distorted, but it does get reversed whenever your forecasted event happens in your subsequent interim period. All right, so moving on to the entities which have multiple jurisdictions. So any entity that has multiple jurisdiction should report the consolidated AETR. So they should calculate the consolidated income of their worldwide jurisdiction and then apply a consolidated AETR to that consolidated income. However, if a company is reporting a loss in a certain jurisdiction and they do not expect to get any benefit out of the loss so incurred in that jurisdiction, maybe the entity is fully valued or whatever, that loss should be excluded from AETR, and that loss should also be included from your YTD actual income in order to report your tax expense in the interim period. And for such entities that have a loss without benefit, you should calculate a separate AETR and then apply it to the YTD actual income of that jurisdiction. So for example, if you have a loss in country Y, so you would calculate an AETR for country Y specifically and then apply that AETR to the YTD actual results of that entity in jurisdiction Y. So that was all I had to talk about the interim period reporting and ASC 740 today. And please, once again, I would insist everyone to subscribe to my channel so that you can get the full access to all the data, all the content that I have posted on my channel. Thank you for your time and thank you for listening in.